Current market data indicates that Roblox Corporation, trading under the ticker RBLX on the New York Stock Exchange, is currently sitting at exactly $88.51. This represents a significant intraday decline of $5.83, translating to a sharp downward move of 6.18% for the session. While the broader indices are navigating their own complexities, seeing a high-growth name like Roblox shed over 6% in a single trading day naturally triggers a wave of anxiety across retail and institutional desks alike. If you're logging into your Fidelity mobile app or checking your Robinhood stock trading dashboard right now, that red percentage is likely the first thing grabbing your attention, and it demands a much closer inspection than just accepting it as a random fluctuation. The expectation from the majority of the market has been that Roblox is a perpetual growth machine, a platform that defies the laws of gravity because it effectively owns the leisure time of an entire generation. Investors have largely operated under the assumption that the company's transition from a child-focused gaming hub to a broad-spectrum 3D communication utility was going smoothly. The narrative was simple. Kids grow up, they stay on Roblox, and the monetization flywheel spins faster. However, the reality we are witnessing today suggests a sudden and violent repricing of that optimism. The drop to $88.51 is not just technical profit-taking, it is a reaction to a fundamental challenge regarding the company's ability to sustain its viral hit rate and the monetization of its aging demographic. The disconnect here is between the expectation of linear, unending user expansion and the reality of content fatigue, highlighted by analyst concerns that massive hits like Steal a Brain Rot may have already seen their peak engagement, leaving a vacuum that new content has yet to fill. When we look at the specific price action today, this 6.18% drop is distinct because it comes on the heels of a downgrade from a major financial institution. JPMorgan shifting their rating from overweight to neutral is the kind of move that forces portfolio managers to rebalance, creating the heavy selling pressure we are seeing on the tape. Volume is elevated, with over 8 million shares changing hands, indicating that this is not a retail panic, but a larger structured exit by larger players who are likely reevaluating their risk exposure for the upcoming quarters. If you look at the charts on your Interactive Brokers trading platform, you will see that the stock sliced through the $90 psychological support level with very little resistance. This level had previously acted as a floor during the last consolidation phase, and breaking it so decisively signals that the bears are currently in control of the short-term narrative. For the individual investor trying to make sense of this, it is crucial to understand that Roblox is often traded in a basket with other high-beta technology stocks. It frequently moves in sympathy with broader sentiment around the metaverse and gaming sectors. But today's move is idiosyncratic. It is specific to Roblox. While you might see Nvidia stock holding firm because of its semiconductor dominance, or Apple stock remaining relatively stable due to its massive balance sheet, Roblox is being punished for its valuation premiums. When money becomes expensive or when growth forecasts are trimmed even slightly, companies with high price-to-earnings multiples, or in Roblox's case, those still prioritizing cash flow over GAAP profitability, are the first to get hit. It's the classic tension between paying for future potential and demanding present-day performance. The concern right now isn't just about today's price, it is about the 2026 headwinds that analysts are starting to whisper about. The fear is that the platform's growth in the 13 and over demographic might be coming at a higher cost than anticipated, or that the advertising revenue model is taking longer to mature than the bulls would like. If you are managing your own funds, perhaps through a Schwab Intelligent Portfolios setup or using SoFi active investing tools, you have to ask yourself if you are holding this for the trade or the thesis. The trade looks broken in the short term until it reclaims the $90 mark. The thesis, however, depends entirely on whether you believe the current engagement dip is a structural flaw or just a temporary lull in the content cycle. Let's take a step back and look at the company itself, because amidst this red sea of price action, the business model remains one of the most fascinating in the entire public market. Roblox is not a game studio, it is a utility for human co-experience. They don't build the games, they build the tools that allow millions of developers to build the games. This is a crucial distinction. It effectively offloads the creative risk to the user base. If one game fails, there are 10,000 others launching the same day. This developer ecosystem is their moat. When you invest in Roblox, you are essentially investing in a decentralized economy where the company takes a toll on every transaction that happens within its borders. It is closer to being a sovereign nation with its own currency, Robux, than it is to a traditional video game publisher like Electronic Arts or Take-Two. The financials reflect this unique position. The company generates massive amounts of bookings, which is the non-GAAP measure of revenue that accounts for the virtual currency sales. When a user buys Robux, that money goes into bookings immediately, even if it's recognized as revenue over the lifetime of the user. This creates a situation where cash flow can often look much better than the net income line, a nuance that often confuses new investors who are just looking at a PE ratio on a Fidelity mobile app. In recent reports, we have seen daily active users, or DAUs, surge past the 80 million mark, a staggering figure that rivals some of the largest social networks in the world. But the metric that matters most to Wall Street right now is bookings per daily active user. If that number flatlines, the stock drops, and that is exactly the fear catalyzing today's sell-off. We also have to consider the broader context of how retail investors access this name. Platforms like Robinhood and SoFi have democratized access to stocks like RBLX, meaning the shareholder base is younger and more connected to the actual product than perhaps any other company in the market. A significant portion of Roblox shareholders are likely Roblox users or parents of Roblox. This creates a feedback loop where sentiment on the platform can bleed into sentiment in the stock market. If the servers go down, or if a popular game is banned, you might see a flurry of selling on Robinhood stock trading apps simply because the user base has a direct, real-time pulse on the product's health. This is a dynamic you rarely see with something like Exxon or Johnson & Johnson. If you're looking at the technicals, the $88 level is precarious. If it fails to hold here, the next major support zone is likely in the mid-70s, which would represent a full retracement of the recent rally. Investors using interactive brokers' trading workstations will be watching the volume-weighted average price, or VWAP, very closely. If the price can stabilize above today's low into the close, we might see a dead cat bounce tomorrow. But if the selling accelerates into the final bell, it suggests that funds are liquidating positions, not just trimming them. This is where having a disciplined approach, perhaps aided by investment help from a financial advisor or a robust self-investing strategy, becomes vital. You do not want to be catching a knife unless you have a very long-term horizon and a high conviction in the metaverse thesis. Comparing Roblox to its peers offers another layer of insight. Unity Software is often cited as the closest public comparison, but Unity is a B2B engine provider, whereas Roblox is a B2C consumer platform. They are fundamentally different businesses. A better comparison might actually be YouTube. Just as YouTube allows anyone to upload a video and find an audience, Roblox allows anyone to upload a game and find a player base. The difference is video is passive and 3D gaming is active and social. This social layer is why retention rates on Roblox are so incredibly high. It's harder to leave a platform where all your friends are hanging out than it is to stop watching a video channel. This network effect is the primary reason why, despite the 6% drop today, many long-term bulls will view this as a buying opportunity. One of the more interesting developments is the company's push into advertising. For years, the platform was ad-free, relying solely on virtual goods, but now they're introducing immersive ads, billboards in games, branded experiences, and portals. If they can execute this correctly, it unlocks a massive new revenue stream that is pure margin. Imagine Nike or Chipotle paying millions to have a presence inside the most popular Roblox games. This is already happening, but it is in the early stages. The market is skeptical about how much revenue this can actually generate in the near term, which contributes to the "show me the money" attitude we are seeing in the price action today. Comment below how many shares of Roblox you currently hold and what your average buy-in price is. I'm genuinely curious to see where the community is positioned on this one. Furthermore, we must discuss the Aging Up initiative. For Roblox to justify its valuation, it can't just be a platform for 9-year-olds, it needs to capture the 13 to 24-year-old demographic. This is a notoriously fickle group. They have access to high-fidelity games on consoles and PCs, so Roblox has to offer something unique to keep them. They are doing this by improving the graphics engine, adding voice chat, and enabling more mature content types. The success of this initiative is the single biggest variable in the stock's future performance. If they succeed, the total addressable market expands tenfold. If they fail, they're